Susan, I will ask you one more question as we move on to this technology section of the Tradecast. Can data and big data play a role in terms of MSME risk scoring? And perhaps could there be a new, better role for credit ratings agencies within this?
The answer is yes, yes, yes. And everyone on the call is aware of that, and I agrees. On a global scale, we've mentioned the sort of plight of the MSME, but I'd like to talk about the impact, and I'd like to celebrate them for a brief second here. You know, on a global scale, MSMEs engage in trillions of transactions. The world is teeming with goods and services changing hands because of MSMEs. So they're so small in individual isolation, but they have such a big impact with what goes on in the world. So we often we often think about how can we help them and how can we get them access, because the access to finance gap is in the trillions. But in reality, you know, we also want to celebrate them, and we're helping them because of the role that they play globally in both economies and other 200 million MSMEs over the world. Those are people taking risks, working hard to create better lives for their families and improve their communities through the services and goods that they provide. Sort of like all of us, they're part of us in that sense. So absolutely a systematic process for collecting, reviewing, understanding that data that tells the story of these efforts, both the successes and the failures. It's a chance to open the doors both deep and wide for a segment. For bankers on the call, our view is because MSMEs, it's such a large extent, lack access to finance, particularly during crises times. This offers a great opportunity for growth in local markets, because that is the segment just waiting for attention and care. But we do see that $5 trillion gap in emerging markets alone. The main driver was what I call murky risk. So financial institutions statistically unsure of the risk they were taking with each individual SME. That's impossible to price if it's statistically unsure, and also real sector B2B buyers uncertain of those operational risks. So the confluence of increasingly available data, of course, if absorbed and assessed in a confidential, structured, consistent way, that's exactly what's needed. It's the thing that will open the door for this whole new segment, which creates opportunities across the board. And again, Claire mentioned this great example of how to get involved, our partnership with MasterCard, Coca-Cola, and Friends as well. That's a way of not just getting finance to these micro enterprises in Indonesia, but it's also a way of connecting them. It's brilliant, Claire and MasterCard, of connecting them into sort of a system that can start to record their credit history. And for the first time, when bankers look at there as a potential for a loan, they're going to know a little bit more about those SMEs and how they're doing. So absolutely, credit reference agencies, they can innovate to contribute to this new slice of data collection and maintenance and analysis. They can innovate to partner with those who are already artificial intelligence masters. But that requires the construction of multi-directional trust. And we've already mentioned the cost of digitization. A lot of times, some of these agencies just don't have the budget or don't think they have the budget to connect. And so it's finding a way to connect them, because their role in most of these markets, they have a great deal to contribute.
Thanks, Susan. And I think the idea of that murky risk is a very good analogy there, and I'm probably going to steal that off you. $5 trillion trade finance gap, and I think to many of the participants who are asking questions, Inderjit Singh as an example, in talking about the digitization capabilities and supporting deep tier suppliers. Claire, what role can data play in advancing access to trade finance?
I think it's absolutely critical, right, as Susan pointed out. And I think there are the traditional ways where we've used data, right, and we've built up, you know, credit agencies, and clearly they play a very pivotal role to continue to do that. and the trust then that they create around kind of extending financing by having those credentials. I think in terms of what we've learned and what we've seen, that isn't always necessarily available for these segments of the market that we're trying to address, right? So we need to find more dynamic ways to get at the data, right? And create a digital history for the micro SMEs and the SMEs. So, you know, and Natasha and I were talking about this in our briefings. It's like, what can we do around open banking, right? And spearheading that into these sectors, right? Because the biggest asset, apart from their people that a company has, is their data, right? So there's a real opportunity through open banking to, you know, explore and exploit the use of a company's own data and get, you know, access to their performance history in terms of the delivery of goods, the quality of goods, and also their payment history. So you can create a dynamic, real-time, relevant credit passport for companies. So I think we need to explore new ways. You know, we've obviously got the regulation has opened up in Europe. We're seeing a lot more happening in US and Australia and Latin American open banking. So for us as MasterCard, it's really kind of thinking how we can play that infrastructure role of that standardization and using technology to get at the data, working with obviously the banks, development banks, and the technology companies.
Thanks, Claire. And a very interesting questions come through from Ian Laverty, which I'm going to ask you, or feel free, anyone else on the panel to answer this. How do we solve the issues around the cost of data? So banks need good data to provide finance, but data in emerging markets is very limited. This means data providers charge more to provide it, making it prohibitively expensive in the markets that need it the most. What can be done, and how do we work with data providers to up their game?
I'll kick off on that. I think it's clearly it's getting access to the data using technology, right? Using the technology, using the partnerships, and thinking about the ways we can do it differently. So I think it's just about kind of working with different groups in the ecosystem, and then, you know, not necessarily solving for solutions differently, country by country, you know, bank by bank, is creating that standardization. But I honestly believe it's down to actually digitally enabling those companies to get access to the data and creating, you know, a standardization around that. Then we'll get the cost benefits, because we'll be able to replicate something at scale.
Thanks. Brian, do you have anything to add there? And also, would you be able to talk about, I guess, the use cases for other new and developing technologies such as AI and ML with respect to credit decision making?
Yeah, just to follow on from Claire's point, she's absolutely right. I think it's up to all of us to work towards standardization of data. That's the biggest challenge. Even with things such as the name of an organization, maybe operating in different countries, it might have a different name, you know, et cetera, So initiatives such as the GIEF and others, I think, are going in the right direction. And the ICC is pushing this very hard with the regulators as well to try and come up with a standardization way of looking at data. It's very, very, very key. In terms of AI and machine learning, it's been a technology that's been talked about for a long time, but I think its time has come now. I think we see the impact on traditional trade finance is becoming quite significant. If we look at the areas of cost with for banks doing business in trade finance, it's compliance checking, it's document checking, hugely manual tasks, looking at paper, looking through paper. And this is where machine learning and AI are really having an impact. Certainly the bigger banks have been using it for a while, and as we have with some of our bigger customers. And the impact has been tremendous in terms of cost reduction, you know, up to 80% in some of those areas. And probably as important is the reduction in risk. So with using AI and these other technologies, you get a much better coverage of risk. I'm not going to ask any of the panelists to comment on what I'm about to say, but I don't know of a bank that does manual compliance checking that does 100% compliance checking. It's just an impossible task for a bank to do. Using the newer technologies, you're getting to sort of 90% of the compliance checking. And that's the fundamental level. And I think you see the impact that's having. And coming back to the democratization, that's now available, I think, for the smaller banks to have as a service. So previously, coming back to what I was saying before, the bigger banks would invest in that technology, apply that technology, and usually at some cost and some pain. Now it's becoming more of a service. So I think that's very important, and that'll help reduce the costs for the smaller banks. But if you look at the higher level, and we've touched on this already, and that's about data. Having data lakes, huge data lakes of this data in different formats, different definitions, is very costly to assimilate what's actually happening. And I think the application of machine learning to that data can recognize changes in behavior, changes in trends that will get banks and non-banks that are increasingly involved in trade finance, get them ahead of the curve rather than waiting for the shock. They can now use artificial intelligence to look at the data, changes in behavior, and be ahead of the game. And we see some of the banks using this to predict about what's to happen rather than wait for it to happen.
Thanks, Brian. And I think I'd like to extend a welcome to some of our listeners joining us literally from all around the world. We've got people from Malaysia, Amsterdam, Ethiopia, Nigeria, Angola, Burkina Faso, Dubai, Turkey. So welcome everyone to this Tradecast. And actually, Natasha, I think that leads on to my next question, because is this causing this kind of tech investment that we see? Do you think that's causing a bit of polarization between some of the large global banks and some of the smaller local banks in emerging and developing economies, particularly those correspondent banks and those that perhaps can't afford the digital transformation and various technologies to help them?
I definitely think it's having a bit of that effect. At the end of the day, the development of these technologies takes a lot of investment, right? So, if you want to use machine learning on a set of unstructured trade documents that I'm sure many people on the line know what that can look like, document pack that's been presented under an LC where something's been faxed and something's been stamped on, and somebody scribbled on it and tested their pen out on it. And then you expect that to go through an OCR process to be converted to digital data. And then you want a machine learning algorithm to do something intelligent with that will also satisfy the compliance requirements of a modern bank, which are pretty fearsome. You are asking a lot, right? That takes a lot of investment. And so I really agree with Brian that there's some really interesting partnerships popping up between kind of technology specialist companies and sort of big banks with big pockets and technology budgets that can kind of invest in some of this stuff. What that does, if you don't do anything smart with it, of course, is it leaves those without the deep pockets behind, which is the vast majority of trade finance banks in the world, given that, there's a big falling off once you get below about, I think, 10 trade finance banks in the world, and then there's thousands and thousands below it. And for those banks, the question is going to be, how can we deliver the technology to them in such a way that it does not require them to spend enormous amounts of money they don't have on inventing stuff from scratch? And that's where modern models like software as a service and subscription type services that Brian talked about get really exciting. From the JP Morgan perspective, over on the cash management side, for example, we have the Link blockchain, which has some hundreds of banks already securely exchanging data on it. And those banks are not, the big giants necessarily. Some of them are very big, some of them are not so big. But it's a network where we can share information in a democratic way, in a secure way that potentially can be used for all kinds of interesting stuff with regard to compliance data sharing and similar. And in the same way, the data standardization story makes that easier. If we're all using the same legal entity identifier to know who our counterparties are, then that saves an awful lot back and forth between banks that used to go on. So I do think, yes, absolutely, there's a polarization between big banks and small, but also, don't underestimate what those potentially smaller banks are going to do with it. We've all seen in examples of things like, consumer access to banking in places like Africa, where some of those populations just leapfrogged the developed markets and went straight from no banking to fully mobile phone based banking at a time when everyone in Europe was still queuing up outside their bank branch. So, there's a big opportunity there, I think, for the EM banks, for example, to really jump forward in terms of their technology capability. But there's got to be providers out there who will offer it in a way that it doesn't require massive investment upfront.
Thanks very much, Natasha. And going back to Brian's point earlier, a comment from Alex Gray. Hi, Alex at LIBF. He agrees with you, Brian, regarding that reduction of risk, and says there is also the aspect of risk on the wellness of the teams handling the documents. I think that's where we really do see those biggest issues. AI potentially reduces the drudgery and the stress of potentially missing those compliance issues. Any comments there, Brian? Oh, I think you're on mute.
No, I totally agree. And as probably one of the oldest people on this panel, I think the experts that are willing to do that is a diminishing pool of resources. So there's that challenge for banks as well. I think it's the expertise is getting older.
Thanks, Brian. So let's move on and talk about partnerships. I'm conscious of time. I think we're going to run over by around 10 to 15 minutes, if that's okay with everyone, because I think this is a really exciting discussion. Let's talk about B2B marketplaces and networks and partnerships. Claire, can these help build resilience and increase choice without creating digital islands? And can I ask you to also define your opinion of what a digital island is as well?
Sure. Look, it's logical. We've certainly seen the acceleration of partnerships. I would say Natasha made the point earlier, even from the bank standpoint, the last 3 years, so even pre-COVID, no doubt that has significantly accelerated, right? Because it's had to. I think just to take a step back on partnerships, right? I mean, my role is to run partnerships. And I think partnerships are great, but you've got to be really mindful of kind of selecting your partners, right? And there are kind of ingredients, and believe me, we've had some really successful partnerships and some non-successful ones, right? And you take the learnings from that. I think you've just got to really kind of think about what's your reason to partner? Why are you here? What are you actually focusing on? What's your problem that you're solving? And really focusing on the customer, not just the fact that a great company here and a big company here, 2 big companies are partnering, so we're just going to solve all these problems because we're really 2 big companies. I think you have to really focus on why you're such a great natural fit. And actually, when you're telling people and informing the market about your partnership, focus on that why, not just it's about us partnering. So, and there's a lot of groundwork that you have to do to make sure that you're going to be a good natural fit. So for me, it's as much as kind of putting it into kind of selecting the partners and kind of, then you can ensure a much more successful experience together, right? And I think once you do get going, importantly, we all know this, but don't go for the big bang approach, right? It's about kind of taking bite-sized chunks, whether that's starting off with some pilots, moving into full commercialization, like the work we did with Susan at the IFC. We decided we'd start in Indonesia, we'd start in certain cities, and it's incrementally of how you actually execute on it as well, right? So yes, clearly the increase, there's a much more significant increase of B2B digital marketplace than there are even in consumer now. So we see that, and no doubt we're seeing that in freight as well, which has been, as we all know, such a manual kind of led industry, but given all what it's needed to actually continue and support supply chains in these really stressed times, we see an advent of freight exchanges. We're partnering with a number of constituents across there, right? So I think it's critical about how you go about your partnerships and your reason for partnerships. It would be my advice.
Thank you very much. And a question to Natasha, and I guess hopefully you can go into a little bit more detail there. Can you talk through any real example or case studies of how technology and third-party bank to fintech partnerships have helped some of the programs you offer?
Sure, and if I may, I'll go back to that Bridgestone example I mentioned very briefly earlier, just because it's one that I'm allowed to talk about publicly. But that's a very nice partnership, right? So you've got, what you have there is you have one massive corporate buyer in the form of Bridgestone. You have many thousands of small suppliers who supply all kinds of different stuff in different countries around the world. You have EcoVadis, which is a third-party environmental auditor, which gives a sustainability score, and they will work based on the targets of the individual company. And obviously, I'm sure we've all, so this is sort of intuitively obvious to all of us, but different corporates have very different targets in terms of what they want to do. Do they want to drive financial inclusion with their supplier base? In this case, they wanted to drive better environmental performance. Do they want to pick out particular suppliers for particular support? So EcoVadis works on a customized basis to measure the performance of those suppliers against the environmental targets of Bridgestone, gives them a score. And you can imagine for the suppliers, there's a couple of things they have to do to meet that data requirement, right? First, they have to sign up with EcoVadis and open up their operation to give that data to the auditor. And this would be true of any form of auditor of any kind of topic, of course, which in itself comes with a cost and some effort to them. And many of them are in markets where that's not the easiest thing to do. And then they have to incrementally improve that performance over time. So once you're reporting a score, it's not good enough just to be reporting. You've got to be showing that your performance is actually improving. And EcoVadis takes that data, does the audit, feeds it directly into Taulia, the fintech front end, using an API connection. And Taulia feeds it to JP Morgan, running the supply chain finance program, and then the financial incentive is kind of automated into the process. And it's that automation piece that makes the exciting sort of part of the structure, because then of course you can offer it to loads and loads and loads of tiny companies. You're not doing something manual, you're not having to evaluate them by yourself. What's also important, I think, from the kind of ESG perspective, and obviously not wanting to distract the conversation in that direction unless that's where you want it to go, but from an ESG perspective, transparency and accountability is also very important typically to the corporates who are involved. If you're going to do work to improve your environmental performance, you want to be able to prove that that is genuinely valuable work that is actually contributing something to a reduction in pollution, a reduction in carbon emissions, or whatever your target may be. So what the data provides and the partnership between the different parties, what that capability allows for is rigor. The structure can be tight and rigorous and well structured and transparent and accountable. You can prove to any outside viewer that what you're doing is really making a change. And that's the exciting bit to me, because once you have those capabilities, the world's your oyster. You can come up with all kinds of interesting applications.
Thanks, Natasha. It's very clear that standardization of data really is the gateway to lots of things. And I'm very conscious that I haven't brought up the ESG or the sustainability word yet. And we are doing a whole specific trade cast on the impact of climate change and trade. I haven't kind of forgotten about it, but I also feel that if we were to discuss this as a passing off comment, then it doesn't deserve the attention that it should get. So we are very conscious of that, and I'm not going to throw in a sustainability question into this specific trade cast as the topic is slightly different. But actually, Brian, I think one other issue that a lot of people come across is that data sharing piece. Obviously, lots and lots of challenges there. How does this work from a data sharing perspective, and from a Finastra perspective? What are the biggest challenges you see?
So combining that data, as we've discussed previously, along with different system data and sources, is key to getting a much better understanding of what's happening. Sharing that data across platforms is an ambition, a very worthwhile ambition, and there are moves to do that. I think the standard, we mentioned the GLIEF. I think that's a very important sort of start in terms of standardization. Knowing who you're talking to has got to be one of the fundamental aspects of data. So I guess there's a couple of barriers to moving ahead, and one is a bit of a protective attitude from a lot of organizations. data to them is an asset that they probably don't want to necessarily share entirely with other people. I think we see that changing now. I think we've seen even with amongst banks with the Trade Information Network, there's a propensity to share some data amongst each other to get much better systems and solutions out there. But I guess the big break is the threat of GDPR. It's just how far can organizations go without breaking legislation. And I think governments are beginning to see that maybe there needs to be a rethink in some aspects of the application of GDPR. Because GDPR is about trying to maintain security of data and make sure it doesn't get into the wrong hands or is made public, inadvertently, etc. And maybe there are other ways to secure that objective rather than maybe the sledgehammer of what GDPR is. So I think that's the big break that we maybe need to revisit in this context.